welcome to the Trading Market Technicals morning call video for Thursday, October 31st. Happy Halloween to everybody. Just wanted to briefly go run through the numbers. Dow Jones down 61, NASDAQ down 21, S&P down 8.5, Russell down 15.5, and Russell actually is leading the markets lower yesterday. There have been some bearish patterns in the last couple of days in the Russell, or bearish price action, I should say, and we're going to see if this risk on or risk off is obviously apparent. We are down yesterday. That is actually the third down day out of 16 trading days. Pretty amazing stuff. And the reason why is FOMC statement came out, and they actually pretty much held their stance and what they were saying from the September 19th meeting. But the one thing that they left out in this particular commentary was, and I quote, "But the tightening of financial conditions observed in recent months, if sustained, could slow the pace of improvement in the economy and labor markets." And that, the elimination of tightening of financial markets portion of the statement suggests that the Fed might not be as far out of the markets that have been hoping for, meaning that they're anticipating a March taper to begin tapering. This actually could be sooner, as early as December or January. So that's where the markets are afraid of, and obviously so because of the fact that we are up at these lofty levels, indeed because of the Fed accommodating and continuing their asset purchase program. So if they are starting to taper sooner rather than later, free money may be coming to a slight end, therefore market participants starting to lock in some profits, okay? So that's what we're looking at right now. Now, the bigger picture is, well, Mark, if we are deciding to head lower, where do we go from here? Well, one day doesn't make a trend, and this is the E-mini S&P, as you can see here. This little red bar is right now what's happened. This is the continuous contract. We're down 6 handles, as you can see here, from the previous day. And remember, and I'll show you a 5-minute chart, why I personally do not like to trade Fed day, only because nothing happens all day until 2 o'clock, which is the wild, wild west. Markets actually fluctuate up, down, and then usually reverts back to the mean where it started, giving us no direction. And usually the following day, we actually continue that movement, which would be the first reaction is lower. So that's what's happening now. But I want to just tell you, we're sitting on the 8. We need to break the 8-day moving average, which really gauges good momentum. As you can see, price usually hugs this thing. Now, if you look at all of the moving averages here, I have the 8, the 20, the 15, 200. They're all pointing higher, and they're well. The distance between them are, as you can see, pretty much separated. Now, obviously, the first logical support would be the 20-day moving average, which would come in about 1728, and that's also the previous high. Okay, that would be really the first logical spot. And then you would see where we would go from here. We also want to measure how the pullback is. Is it shallow? And to me, as of right now, this would be kind of a shallow pullback, only because all of the moving averages are lining up in bullish symmetry, as you can see here, and they're pointing directly higher. So there's really no reason to suggest that this market is going to crash, this market is going to sell off, at least for now. And I like to let the markets prove itself before we start putting out any type of statement. Oh, we're going to have a crash, we're going to have this, we're going to have that. That's really not the case. That's not the way I like to do technical analysis. So this is the 8, 20. I'd like to get us back down into the 20, and then we would reevaluate it. And even if it got down as far as 1700 down here, we are still in a bullish uptrend, making higher highs and higher lows, as you can see. Now, there's 2 trend lines coming in at the November 2012 lows. Even if you caught this trend line, which would come in at 1660, as long as you don't take this pivotal low out from the October 9th low, then this would say to us that the uptrend will continue into the new year, and then you would reevaluate it. However, if we do close below this on a closing basis, and I don't mean in one day, I mean a couple of days, and then start to kind of chop around, try to pull back up and fail, or try to move lower, and then back test this upper trend line, then that to me, that would significantly say that we are now indeed trending lower, and that would give us the trend change of the lower high and lower lows. So that is what I'm looking at for now. As of right now, yes, I am looking for that pullback. I did mention that to you. When you get this far, this stretched, it's just only logical that the markets are indeed are dying for some sort of a pullback. Okay, so that's one of the reasons why I'm suggesting that we are getting a pullback, and it should be healthy. It is healthy for the markets not to sustain a rally like this 16 days in a row. Remember, when you get to a certain point where the markets become oversold, that's one thing. But when stocks start to rally here and then they kind of pause, and then all you have is the indexes rallying, that just tells me that there's more algorithms, more computerized trading happening here, and retail getting in. Because remember, the markets are made to fool a mass. You'll hear me say that many, many times. And the reason why I say that is because hedge fund managers are not buying up in these areas. I can tell you that right now. They're not looking to buy or add to their positions at the all-time highs, thinking it's going to go to 1800 or 1820. And not that it can't, but it's just the ratio, meaning that the risk reward would be more to the downside at these levels than really running up in here. Okay, so a pullback is logical. I believe the pullback will be shallow and bought at this time, but we'll take it one step at a time. Once the markets do indeed start to break down for a couple of days, then we will be looking to sell rallies. As of today, I am looking to probably sell rallies today. And then let me show you a couple of indicators here. And I'm not going to get too crazy with them, but I just wanted to give you a little glance of what I'm seeing. Again, because we are still right now in an uptrend. Markets are still moving higher, so I'm just going to show you a couple. Here's the VIX. VIX had a nice big spike up, but actually kind of closed lower. I'm going to see if this is going to have some momentum to the upside. Now, if we can get above the 200-day moving average and start to really chug along higher, then I can. This would give me more of a bearish bias in the market itself, the general market itself. Okay. Here's another thing that I always look at. Here's the end of day tick. Now, some of the internals of the market, the breadth of the market, is starting to change too as well, losing momentum, starting to break down. Okay. The tick, end of day tick here. This is something that usually needs to stay above zero. Now, yesterday's only one day, and it could actually go even more. Down a little bit more, but we need to see it break. If it breaks lower and holds this area and rolls again and just stays lower in this area here for a few days, a week, that's telling me that we are actually in giving us a turn of the current trend here. So when you have ticks moving lower, this is not a good sign. That means you're going to have more sell programs come in, and that's going to actually put more pressure on the markets here. Okay, real quick, the McClellan Oscillator. McClellan Oscillator here right now still in neutral territory, but what this does tells me that there's plenty of room to run to the downside before we indeed become oversold. Okay, that's the McClellan Oscillator. Stocks above the 50-day moving average, as you can see here, starting to break down a little bit. And again, I've been saying this, showing this chart for about 2 weeks, saying that we are way, way overbought, and we are indeed in dire straits of a pullback. Now, we just crossed it yesterday, just really not giving us a full-fledged sell signal yet. But if the markets remain weak, which we're down about 6.5 in the electronic overnight session, that would really produce a sell signal for today going into Friday's trade. Okay, so we are in a sell signal. As of right now, we would become a sell signal. And here, at the 80 percentile, as you can see what happens when we get to these areas, market sells off. So another thing to take a look at. Another one is the dollar, right? The dollar did muster up 3 or 4 days of upside momentum. Now, we are coming into resistance. We hit the 20 and we pulled back a little bit. Let's see what happens here. Now, if the markets believe that the tapering will be sooner rather than later, you're going to have upside movement in the dollar, which would put downside pressure in commodities, right, and equities. Speaking of commodities, let's take a look at the CRB index, which is compiled about a few commodities: oil, gold, cocoa, beans. This is the CRB index. Now, this here gives me a head and shoulders pattern in the CRBX and a daily. It also gives it to me on a weekly and a monthly, which tells me that we are now really starting to break down. Now, the monthly chart shows a head and shoulders pattern, which the neckline has not broken yet. Okay, but however, in the daily chart shows that it has. So if we have pressure in, let's pick the commodity. Let's just pick oil and gold. And as you know, I'm a better short seller of gold at higher levels. Then this will also just add fuel to the fire of commodity stocks also breaking down in the index. Okay, so again, a lot of things are starting to line up on the downside. We haven't really seen the markets break as of yet, again, one day doesn't make a trend, but if the markets can continue today, maybe tomorrow, then I would say we have something going into next week that we can actually literally take on a small swing short position in the market, which would entice me a little bit better. I wouldn't go out looking just blindly shorting unless you're hedging. If you're hedging your portfolio, that's another story. Or if you're looking for just a day trade to get short, I also think that's also not a problem at all. Okay? Now let's go into the chart segment. And as you can see, I just wanted to show you why I don't like trading the Fed. This is a 5-minute SPY chart. We literally gapped up and we just drifted lower on absolutely no volume until 2 o'clock. And soon as, sure enough, when the initial reaction is lower, the markets actually tend to rally up and close where it actually broke that support and or resistance, for that matter, if it was the upside. And now we usually get a follow-through day to the initial reaction, which was lower. So it's happening now, but remember, it's 5:15 here in the East Coast, so it's got several hours to go before the markets open. That indeed could actually change. But I just want to tell you, that's what usually happens, probably about 65 to 70% of the time on FOMC days. Okay? Now, let's go into the charts. I want to show you crude oil. And I showed you this bear flag yesterday. I say I don't like it. And I said stay away. I wouldn't short it only because I'm always like to buy the USO than short it because of the geopolitical risk in the overnight. I just don't like it. There's a lot of uncertainty out there, and you could have oil open up $2 or $3. So anyway, we did break the bear flag. The next support's going to be in this little cluster area of support. As you can see, the volume profiles are heavy support in this area. So I would look now for USO around 34 to 33.5, where I would take and probably look, once it bases, probably take another stab at the long side like we did here when we did pop up, okay? But right now, no trade in crude oil. Gold. Now, we did get a push lower, again, because if the Fed is going to taper sooner than later, you're going to have downside pressure in gold. And also, seasonal weakness comes in the commodity sector between now and the end of the year. So they're not really favored to move higher. So also added weakness. I mean, if I can get a little pop up a little higher, I would look into short the GLD. Or even if we break this low here, start filling a gap, you know, I'd rather have, it's better to short go GLD at 128 than actually down here, as you can see. So we'll just see what happens. Again, no trade as of yet, but something to look for. Spiders. Nice big uptrend from October 9th. As you can see here, we did break out and close outside of this uptrend line. Okay, we did catch this slanted horizontal cross of the trend line, which we caught here. Now we're going to need to break yesterday's low to really get some momentum to the downside. If we could break yesterday's low, which would coincide with the EMA on a daily chart, the next target would probably be the 20-day moving average, which I would love to see. Okay, here is the diamonds. Same thing holds true with the diamonds, as you can see here, just kind of chugging along, and now we just kind of broke down here. We did fill that little gap, okay, from the previous day. Now we really need to come in. This has a little bit better support, which would be right about the this upper trend line from the 2012 lows. Again, coincides nicely with the 8. This is going to need to crack to get down to the 20-day moving average as well. Then we have the IWMs. Now, our leader here, which is a good gauge of risk, is really starting to lose momentum here. As you can see, for 5 or 6 days, we've had literally dojis, spinning tops at the upper end of the range. Not that it wasn't bullish, because if it holds the upper end of the range, we need to break out. Well, guess what? We broke to the downside. That is not what we want to see. We just came shy of the upper trend line of this upper trend line from the 2012 lows. Now we're starting to break lower. So the first spot will be the 20-day moving average, and this leader, which is the Russell, is following suit. This is following the markets lower. Leading the markets lower. Okay, IWMs, which is the Russell. Transports, another one of our leaders, and I wanted just to show you that, as you can see here, clearly breaking out. Every time we ran into an uptrend channel, we broke down. Uptrend channel broke down. Uptrend channel, repetitive pattern, we should be breaking down. We should at least get to this slanted trend line support, and then the next would be the 20-day moving average, okay? So let's just, again, take it one step at a time. I wouldn't looking to advocate putting on short positions now. Day trading, I wouldn't mind selling rallies today. and see where we go from here. But right now, I definitely see cracks in the walls of the S&P and of course the markets in general as a whole. J.P. Morgan really hasn't gone anywhere. Not good either. We want to see banks to participate as well, and we're not seeing that. Here's Goldman Sachs, really not going anywhere as well. And then, of course, the XLF hanging at the upper end of the range. But remember, look at the IWM, same thing. We have a little bit of a push up. Remember, we only have 1 day down. That doesn't mean anything. People, market participants, will continue to buy the dips until it doesn't work. Remember that. So it's going to be a tougher trade being short, but once it does crack, remember, we're very extended, and the longs are going to be caught up at these areas, and once they start breaking some support areas, they're going to get stopped out because that's where they logically will put their stops in, and then we break the first area, we break the second area, and then we just have basically, it's like a domino effect with the markets indeed starting to move faster and faster to the downside. Okay? When you start rolling off these tops, you don't have as much movement, but when they start breaking, you'll see the market start to move faster and generally move much faster. You know, you could take a week's worth of gains in two bearish days. Okay, Apple held up really well. Apple was actually up yesterday, so this is actually a good sign. Now, usually we do manage to pop up and retrace back at least 38 to 50% of this candle before continuing lower. So let's just see what happens today. Tomorrow is going to be real pivotal for Apple. All right, networking sector, okay, of the technology. This is not what you want to see. You want tech to rally, obviously. So we are now here. We do have this head and shoulders. We haven't broken yet. So the bearish pattern has not triggered. But if it does break, target's going to be this lower end of this trend line of 27.08, rounded off to $27. Okay, so this is something I'm going to keep an eye on too to see within the tech sector what's weak and what's not and holding up. But big cap, high beta names like LinkedIn, Google, Netflix, aside from Apple, which was up, they're all succumbing to some selling pressure. And logical, they've been up dramatically and are indeed for a pullback as well. And then lastly, as you want to show you the Qs. Qs weekly, as you can see, coming into some topside pressure of this uptrend line. That's the weekly chart, as you can see. And the daily chart, we did break out of this channel, as you can see, repetitive patterns here. We're outside of the channel from the October 9th, 2013 lows. So now this, to me, if we break yesterday's low, we should be headed at least to the 20-day moving average. And then we would reevaluate it, okay? All right, guys, be safe today. It is Halloween. Enjoy time with some family. Go out there trick-or-treating later on this afternoon. Have a great day. Be safe, and we will speak to you tomorrow. Take care.